Welcome to the Finpari binary option tutorials. Lesson 7. In this lesson, we will talk about the price action in general and the reversal patterns in particular. A reversal pattern is a pattern of two or more candles that signals about a potential reversal of the dominating trend. Let's talk about the Pinocchio reversal pattern. We all know the story about the Pinocchio, the boy whose nose grew longer anytime he told a lie. A pin bar is also called a Pinocchio bar because it is telling us that the market is lying, and the length of the pin indicates the elongating nose of Pinocchio. As the market price moves in the direction of the trend to a certain level, it suddenly retreats all the way back to near the opening price. Thus, it lied as to where the price was headed and should start moving in the opposite direction. Particular importance should be given if Pinocchio was formed on the important levels of support and resistance, or around price levels. Let's see how this pattern looks like and what conditions must be met according to the strategy that we developed for this pattern. As you can see, model consists of three candles, bars. The key candle that is in the middle should have a small body, meaning that the opening and closing price must be close to each other. The smaller the body of the candle, the stronger the signal. Also, the middle candle must have a large tail or shadow, which goes far beyond the surrounding candles. Additionally, candle body must be within the previous candle. And finally, candle body must be on one end of the tail, essentially looking like a mallet or a hammer. So what is the Pinocchio strategy for binary options? Assume that the price of an asset for some time had an uptrend or climbing up. Once you see that the pattern began to form, or rather candle with a large tail, analyze it and see if it fits the parameters that I'm showing you now. Wait for the next candle to cross the maximum or the minimum of the key candle and open the option in the opposite side of the tail. On this chart, you can see an example on 1 hour time frame, meaning that each candle represents the movement of the price in a given 1 hour time frame. You can see already formed pattern. According to the strategy for binary options, you must buy a put option at the point which is marked by the black line. The expiry in this case is the closing of the bar that follows after the pin bar, which in our case is 1 hour. In general, the expiry time should be equal to the time of the pin bar formation. This strategy can be used on options with different expiry times. If the expiry time is 15 minutes, then look at the 15-minute chart. And if you are analyzing 30-minute chart, the expiry must be also 30 minutes. Pay special attention to pin bars that are on the highs or lows or close to a critical levels. If a pin bar is surrounded by candles with small bodies, it is better to skip it and don't trade. Now I'd like to also introduce another very interesting reversal candle formation. It's called Doji bar. A doji is a reversal model that is formed when the open and close price of the candles bars are the same or almost the same, and there is little difference between high and low. This model reflects the uncertainty of the market, and it's likely that the price of an asset will reverse and go against the prevailing trend. What doji can be taken into account? There must be strong trend before the formation of the pattern. The open and close price of a doji candle are the same or nearly the same. Before doji candle, there must be a large full-bodied candle going in the direction of the trend. And finally, after the doji candle, there is a candle which goes in the opposite direction of the dominating trend. If these conditions are not met, then don't take this figure into account. It is best to pay attention to doji candles which are formed on the hourly charts. This will save you from making mistakes, because on the smaller time frames, there are a lot of noises that can distract you. So what kind of strategy can be used with doji candle on binary options? Suppose before the formation of doji candle, asset price was going up. A doji candle has been formed, followed by the candle moving in the opposite direction, down. You should buy a put option after the candle breaks the lower extreme of the doji candle. Same applies if a doji was formed in a downtrend. Buy a call option upon the breakout of the high extreme. As you can see, it is a very simple model that helps a beginner to make money on binary options. The most important is to strictly follow all the rules. Okay, now let's talk about another reversal pattern which called inside bar. An inside bar is a reversal formation characterized by a bar that forms totally within the trading range of the preceding bar. Inside bars reflect a balance between the buyers and sellers, or in other words, uncertainty in the market, which is sometimes later resolved by a change in trend. So what is the complexity of trading this setup? The difficulty lies in the fact that the price may go up as well as down, so you should pay attention to the inside bar. If it formed at the highs or lows, and if it's near important price levels. Now I would like to explain how to apply this setup to trade binary options. When the inside bar was formed, it is necessary to get additional confirmation of the reversal, like important levels, moving averages, and so on. Then watch the candle after the inside bar. You need to buy a call or put option depending on which way the price will break outside the bar. In the first case on this chart, the next bar went up. So you should buy a call option immediately after the price breaks above the maximum of the inside bar. As already mentioned, it's pretty complicated setup for beginners. So when you see the inside bar, you should not rush to buy an option immediately. Practice to determine the direction of the trade on the paper, and then you can apply this technique in real trading. Now the final pattern I would like to talk about is the outside bar reversal pattern. The outside bar is the analogy of the inside bar setup. Just look at it as the inverse model. A candle can form an outside bar pattern when it completely covers the range of the previously printed candle, taking out the previous high and low. This pattern tells us that the market will change its trend and go in the opposite direction. It is not a rule without exceptions, so confirm your setups, watch support and resistance levels, Fibonacci levels, and so on. Candles with a large body and small shadows have very high importance. This indicates a strong signal. It is not worth paying attention to huge outside bars formed on the news release, as they can provide false signals. In case of formation of an outside bar pattern, you need to buy an option in the same direction as the outside bar. On this chart, you can see that before the formation of the outside bar model, the price went up. Market reversed and the price went down. In this case, we would have bought a put option straight after the closing of an outside bar. If the candle of the outside bar is quite large, it may not be worthwhile to wait until the price retraces, and you can enter at a better price. In regards to the expiry time, it can be 2 to 5 candles long, based on what time frame you use to analyze the chart. If you follow the hourly chart, the period of expiry would be 2 to 5 hours. At the end of this lesson, as usual, we will have an assignment. Look at the historical price movement of a chosen asset and try to find patterns discussed in this lesson. Try to see how predictable the price was after the formation of these patterns. In the following lesson, we will learn the most important indicators and how to apply them to our strategy.